Hello students, this is Professor Vincent Usaga. Welcome to my class. This is part 2 presentation of chapter 15, Stockholders Equity. This is where we left off in part 1, the corporate form of business. Here we are talking about a variety of ownership interest. What does that mean? That simply means that ownership of a corporation comes in different shapes. One shape is buying a stock called common stock. Another type of ownership is you buy a stock or preferred stock, and you have ownership, but a different type of ownership. So let's take a look at these two types of ownership. So common stock, we said, is the residual corporate interest, meaning the common stock or the common stockholders are actually the true owners of the company. They wind up reaping the ultimate benefit, and they also wind up being in a position to take the most risk in terms of the benefit and the risk of owning or having ownership of a corporation. So let's take a look at some of the characteristics of common stock. Number one, bears ultimate risk of loss, like we said, receive the benefits of success, are not guaranteed dividends nor assets upon liquidation. Meaning that the dividends, which is one of the benefits that you enjoy as a shareholder, those dividends are not guaranteed, and upon liquidation, you get to, upon liquidation, meaning when the company go belly up, whatever is left after, if any, after everybody has been settled, is being distributed to the common stockholders. Then we have another type of ownership. We call it a preferred stock. It's a special class of stock. We call it a preferred stock because this stock has some preferences over common stock or over common stockholders. And some of the preferences are: preferred stockholders get dividends before common stockholders. In the event of liquidation or in the event of business failure, the preferred stockholders get a piece of whatever is left before the common stockholders. So the list of privileges that the preferred stockholders get is really more than that. But in a nutshell, that is basically some of the differences between the two types of stock. So moving along, let's take a look at the key components of stockholders' equity. This is very important. Here we said that the two primary sections of the stockholders' equity, number one, a contributed capital, and number two, retained earnings. I really don't like the way this diagram is presented. Let me go ahead and align exactly what is happening here. So you have assets, liabilities, and you have stockholders' equity. As you know, of course, we have current assets, then we have long-term assets. Now for liabilities, we have current liabilities, we have long-term liabilities. For stockholders' equity, we actually have two main components of stockholders' equity as well. We have contributed capital, and we have retained earnings. So we have two sections. If I may display this in a different way, we have two sections under the stockholders' equity. We have the contributed capital, and we have retained earnings. Now that is what they have here, but in a slightly confusing way, because this is number one component of the stockholders' equity section of the balance sheet, and this is the second component. So they have here two primary sources of equity. Number one, contributed capital. Number two, retained earnings. Now, under contributed capital, we have common stock and we have preferred stock. Under the contributed capital, then of course we have additional paid-in capital account. We are going to talk about that in a minute. Then we have a retained earnings as the second component. Now, in summary, basically what we are talking about here is number one, contributed capital. That is the capital or the investment that the owners contributed into the company. So we call it contributed capital. And the owners contribute the capital or make investment. How? By way of buying either common stock or preferred stock. Now, the second component of equity or ownership is retained earnings. Like the name suggests, earnings, another word for earnings is net income. Another word for earnings is net profit. So whatever profit or net income that the company did not give to the owners of the corporation in form of dividends, we call that retained earnings. So if a company makes $10 million profit or net income, and they give $8 million to the owners of the company, then the $2 million left is still belongs to the owners of the company. The company is keeping the $2 million for different reasons. So we call that retained earnings, and that is part of equity of the owners of the company. And of course, treasury stock, we are going to talk about this in a few minutes, is a reduction of stockholders' equity. Now, like you know, of course, assets minus liabilities will give you equity, or assets equals to liabilities plus equity. Now, moving along, let's take a look at the third objective. Let's take a look at the procedures for issuing stock. Now, issuance of stock. What does that mean? Another word for issuance of stock is sales of stock, meaning we are selling stock to investors or owners to be. So, it is important for me to talk about this. In part 1 presentation, we talked about the difference between stock and share. Now, I also want to talk here about the difference between stock and bond. In chapter 14, we talk about bond accounting extensively. Now, here's the difference. A stock is a certificate that the company or the corporation will sell to investors. So when you buy a company stock, you become one of the owners of a corporation. So the stock is your evidence of ownership. Now, so by so doing, when you buy a company stock, you have an equity or ownership of the corporation. However, when you buy a company's bond, which is another certificate that indicates a company's indebtedness to you, meaning you are a creditor and the company is a you are a creditor and the corporation is a debtor. If you buy a company's bond, here is debt. So bond is a debt security or financial security, while stock is an equity security. So moving along, here when the corporation is when the corporation articles of incorporation or application to become a corporation is approved by the state, part of the information that you indicate in your application is the number of shares that the company is authorized to sell. So we call that authorized shares. So when you complete your application and say 1 million shares and the state approve that application for you, then you do not have authority to issue more than 1 million shares. If you desire to, you have to go back to the state and do more paperwork. So that is what we mean by shares authorized. When after the state authorizes you to issue 1 million shares, now you now go about selling the shares or issuing the shares to investors. So here are some of the accounting problems relative to issuance of stock or selling of stock. Number 1, par value stock. Number 2, no par value stock. Number 3, stock issued in combination with other securities. Number 4, stock issued in non-cash transactions. And number 5, cost of issuing a stock. So let's take a look at each problem one by one. So number 1, par value stock. Now, it is important for you to know here from the outset, don't confuse this par value with the par value that we discussed in chapter 14. Remember, when we talk about bond, we talk about par value also. That par value is the same thing as the principal of the bond, okay, or the face amount, the amount that is indicated on the face of the bond, like 1,000 or 10,000. That is par value. Now, this par value is quite different. Couple of things here. Number 1, you need to know. par value stock is a type of stock, number one. Then number two thing you need to know is par value in this sense means the minimum legal amount that a corporation can sell its stock for. What does that mean? By the time you complete your articles of incorporation or application to have your company to become a corporation, and you said to the state that my par value is going to be $1, that means, and the application is approved for you, that means you cannot sell that company stock for less than $1. So par value is a type of stock. Number one. Number two, par value means the minimum legal requirement that you must sell your company's stock for. So now here they say that low par values help companies avoid a contingent liability. What does that mean? That simply means a company would specify very low par value, like 1 cent, meaning it is not likely that they will wind up in a situation whereby the stock has to be sold for less than 1 cent. When that time comes, obviously the company have to be ready to go out of business. So that is what they mean by that. Now, another important thing that I want to draw to your attention is, the question is, how do we come up with the par value? How do we know whether it is 1 cent or $1 or 50 cents? It is an arbitrary amount, okay? You know, you can specify whatever amount that you want to specify when you complete your articles of incorporation or application to have your company as corporation. When the state approves it for you, then you have to stick with that par value. So here we said that preferred stock or common stock. So par value stock, in other words, you can have a par value stock when you issue common stock, and you can also have a preferred stock that also has a par value. Now, whatever the investor pay above par value, we call that additional paid in capital. So the par value is $1, and you sold 1 share of the company stock for $10. So the company received $10 from the investor. So the par value is $1. So the company sold 1 share $9 above par value. And that $9, we need to track it in a special account, and we call it paid in capital in excess of par, or we also call it additional paid in capital. So here's an illustration of that. This company issues 300 shares of $10 per value common stock. In other words, this is a common stock, a type of common stock that has par value, and the par value is $10. And they issue those shares for $4,500. Now here's the journal entries. Obviously we received $4,500, so we have to debit cash for $4,500. Then we credit common stock for $3,000. You need to cash this. This is very important. So common stock account is credited based on the number of shares issued multiplied by par value. Of course, this is applicable to a par value stock. So in this case, we issued 300 shares for $10, and common stock account is credited for $3,000. Obviously, the difference of $1,500 is credited to a special account. We call it a paid in capital in excess of par. Another way of determining or figuring out the $1,500, obviously the par value is $10. Excuse me, the par value is $10, and we issued 300 shares for $4,500. So again, the difference, like I indicated, of $1,500 is credited to paid in capital in excess of par. So that would be the conclusion of part 2 of this chapter.